All right, everyone, welcome back for another deep dive. Ready to unpack a topic that could make or break your trading journey.
I'd say so, and it's one that definitely attracts a lot of attention, and for understandable reasons.
Leverage. We're tackling it head on today. We've got some intriguing material, lined up articles, forum discussions, even a cautionary tale or two.
Because you can't talk about leverage without acknowledging both its potential and its pitfalls, right?
Absolutely. We'll break it down, what it is, how it works, the good, the bad, and yeah, maybe even the ugly. But most importantly, we want you to walk away knowing if leverage is right for you, and if so, how to use it, well, wisely.
Let's start with the basics. In the simplest terms, leverage is a way to boost your buying power in the market, allowing you to control larger positions with a smaller amount of your own capital.
Okay, so let's say you have $1,000 to invest, and you come across a trade setup that you really like. Now, with 100.1 leverage, something we see quite often, that $1,000 can control a position with $100,000. Sounds almost too good to be true, right?
And that's exactly why it's crucial to understand the mechanics behind it. Essentially, when you're using leverage, you're borrowing the rest of the capital needed for that trade from your brokerage, like taking out a loan. And just like with any loan, there's interest involved, and more importantly, you're responsible for repaying it, even if the trade goes south.
Which leads us to the dreaded M word, margin calls. I think anyone who's even dipped their toes into the world of leverage has at least heard a horror story or two.
It's the risk that comes with the territory. Think of it this way. The brokerage isn't just handing over that extra capital out of the goodness of their heart. They're taking a calculated risk. And if the trade starts moving against you, eating into their potential profit.
They hit the panic button.
Exactly. That's when the margin call comes knocking. It's essentially a demand for you to deposit more funds into your account to cover the potential losses, and it often happens with very little warning. If you can't cough up the cash to cover the margin call, the brokerage can, and most likely will, liquidate your position to protect themselves, even if it means selling at a loss and leaving you with a hefty bill.
So we've established that leverage is not for the faint of heart. But there's a reason why, despite the risks, it remains such a popular tool, and that's the potential for magnified gains. Imagine turning that $1,000 into, let's say, $5,000 or even $10,000 in a relatively short period. It's tempting, to say the least. And we did come across quite a few success stories while going through the materials for this deep dive.
Right, and there are certainly instances where using leverage can be a strategic move. It can allow you to diversify your portfolio, entering multiple trades with less capital up front, or to seize opportunities in markets that might have seemed out of reach before. But those success stories often gloss over the discipline, risk management, and sheer luck that played a role in their outcome.
That's a really important point. So let's shift gears a bit and talk about how to use leverage responsibly. Where do we even begin? What advice do the experts we read offer?
Across the board, they stress the importance of understanding your own risk tolerance. Are you comfortable with the possibility of losing a significant portion of your capital for the chance of outsized gains? Or do you prefer to play it safer, aiming for steadier, albeit smaller, returns? Your risk appetite should dictate how much leverage, if any, you're comfortable taking on.
Makes sense. Don't jump into the deep end without knowing how to swim, right?
Precisely. And once you have a good grasp of your risk tolerance, it's crucial to familiarize yourself with risk management tools. Stop-loss orders are your best friend when it comes to leverage.
It's like setting a safety net, right?
Exactly. You're essentially telling the platform to automatically close your position if the price moves against you beyond a certain point that you're comfortable with. It limits your potential losses, even when the market takes an unexpected turn.
So we've got risk tolerance, risk management. What else?
Start small. Treat leverage like you would a powerful sports car. You wouldn't want to take it for a spin on the Autobahn without first getting a feel for its handling on a controlled track. Begin with a lower level of leverage, gradually increasing it as you gain experience and confidence.
And of course, knowledge is key. The more you understand how leverage works in different market conditions, in bull and bear markets, during times of high volatility, the better equipped you'll be to navigate the risks.
I like to think of it like checking the weather forecast before setting sail. You don't want to get caught in a storm unprepared.
Absolutely. Any final thoughts?
Always have an exit strategy. Know your entry point, set your profit targets, and more importantly, determine your stop-loss levels before you even enter a trade. Leverage can amplify emotions, so having a clear plan in place can help you make rational decisions even in the heat of the moment.
So to wrap things up, leverage can be a powerful tool for traders, but it's not a magic solution. It's a double-edged sword that requires careful consideration, disciplined risk management, and a solid understanding of both your own trading style and the intricacies of the market.
And as we often see with many concepts in trading, the lessons learned from understanding leverage, things like risk assessment, strategic planning, and even emotional control, these can often be applied to other areas of life, wouldn't you say? Something to ponder on.
Definitely food for thought. That's it for our dim dive on leverage. We hope this has given you a better understanding of this often misunderstood tool. Until next time.